Pricing policies. We're looking at the influencing factors. Under influencing factors, we look at the external factors. The influencing factors for pricing. What are the external factors are? They are shareholders, customer demands, competitors, industry practices, regulation, and intermediaries. These are some examples of external factors. Of course, there are much more than this. External factors. Organization has little or no control over the external factors, but they have to monitor it closely because they have to be careful of the impact it can have on its pricing policy. Shareholders need to be remunerated for providing the capital. When shareholders invest in the banks, they're expected to be rewarded, either through rewarded for their investment in the bank. The investment can come in the form of share price, increase in share price, or dividends. So one example is dividends payout from a bank. Customer. There's relationship between the price and level demands. They're also responsive of demand to price. So under customer, there are these two factors we need to consider. Relationship between price and demand. It has an inverse relationship between the price and the demand level. Usually, high price will lead to low demand, and low price will lead to high demand. Usually, that's the case. However, there are certain situations where high price still lead to high demand, such as iPhone, because the high price of iPhone is deemed to be a premium. Okay, you're paying for a premium product. The iPhone is deemed to be a premium product, so you're paying a high price for a premium product. So look at the graph here. Okay, the graph shows an inverse relationship between the price and demand. It's curving downward. So basically, high price, as the price goes up, the level of demand will drop. The demand or quantity will drop. Sometimes higher prices can lead to higher demand because of this perception that high price is taken as an indicator of high quality. Because sometimes customer may have doubt if the price seems to be too cheap for a premium product. Responsiveness of demand to price. Let's talk about how demand responds to price. If it's a lot, if the response is if the demand is very sensitive to price, in this case the demand is elastic. Let's look at this diagram. This line shows a very elastic demand. It basically means the customer is very sensitive towards price changes. So when the price move from P1 to P2, the price drop from P1 to P2, you can see the Q1 to Q2, there's a very big change. So basically, when price drop by a bit, there's a great demand generated for this quantity. Okay, rather there's a great demand for it. So basically, as a result, you increase your total revenue. So it makes sense for the bank to drop the price, okay, to increase the demand that leads to the increase in total revenue. On the other case, when demand response to price is little, or rather insensitive to price changes, we say that the demand is inelastic. So for here, the demand is inelastic. You see the line is very different from the previous one. The previous one is quite flat. This one is quite steep. So when price move from basically the price, okay, what you do is that you increase the price, okay? Since the demand doesn't change much, you see the demand that you increase the price from P1 to P2, but the Q1 drop to Q2 wasn't a lot. So in this case, the bank can increase the total revenue for it, since the demand will not change much with the higher price. Okay, this is a situation where, like for example, Microsoft, for Microsoft Windows, there isn't much competition here. So basically, Microsoft can effectively set the higher price, and generally people will still buy Microsoft product, okay, because there's not much, or rather there's no alternative, okay, product for Microsoft. All right, Microsoft Office. Market elasticity versus bank elasticity. So market elasticity, take note the word is market, okay, is basically see how the total market demand responds to the price changes. If it's elastic, okay, if you increase the price, the market share size will decrease. Whereas for bank elasticity indicates that how willing the customer are willing to shift bank, okay, on the basis of price. So basically jump from one bank to the other bank. If it is elastic, okay, if the bank increase the price, the sales of the bank products, okay, basically the bank sales will decrease. Competition. This factor is crucial, as consumers tend to view banks and their service alike. Just like saving account for the 3 local banks, there isn't much difference, okay, between the saving accounts offered by OCBC, UOB, and DBS. If the prices are noticeably higher than those of competitors, sales will be lost. Where banks have similar cost structures, price cutting can destabilize the market and lead to price war. The final result is that the total revenue for all the banks will drop because all the banks are cutting the price down. So sometimes the banks would not in favor of this, because end up it's a lose-lose situations. So usually the bank will try to sometimes the banks will maybe negotiate among themselves. So price cutting cannot be a long-term competitive tool. It can be only a short-term tactic. This is to gain short-term advantage. Intermediaries, example, brokers, independent financial advisors. This act, basically these intermediaries will add to the overall cost of financial products. As a result, it inflated the price. So bank can overcome it by setting direct distribution channel. So basically, in short, the bank can sell the products directly to you instead going through a third party. This will help to reduce the cost. Regulation. MAS, as the central bank, provides the supervisory and regulatory framework. It's very important that the central bank provides the right supervision, the right framework in order for our financial industry to function properly. One example is the Banking Act. MAS may determine rates of discount chargeable, rates of commission, and other charges.